We're going to continue on banks, and I want to introduce Juliane Begenau, who is going to present on interest rate risk and cross-section effects of micro-prudential regulation, flying in all the way from Stanford. Thank you.
All right, thank you so much to the organizers for putting this paper on the program. This is joint work with Vadim Elenev and Tim Landvoigt. All right, so we are motivated by the observation that banks' assets resemble fixed income securities, fixed income position, such as loans and more directly securities that decline in value whenever the interest rates go up. So banks fund those asset positions with insured and runnable uninsured deposits. And we've noticed, and this conference is no stranger to this fact, that recent rate hikes have revealed some differential exposure to both interest rate risk and run risk in the cross-section of banks. So what we want to do in this paper is to put out a framework that can talk and speak to the differential choices that different banks take in terms of their portfolio and funding risk choices. And we do that in order to then be able to study the effects of micro-prudential regulation with the goal to improve financial stability on the cross-section of banks. So this paper in a nutshell, it is a theoretical model that we then take to the data. We are focusing on the cross-section, so we start with a 2-period, and that revealed a lot of complexity already, so we stop there. Typically write down time series or panel dimensions. So we do this, so we write down this 2-period model to analyze the funding and portfolio choices of the cross-section of banks. The key ingredients are heterogeneity in banks' lending and deposit productivity, as well as product differentiation in the insured and uninsured deposit market. And then banks make a portfolio choice between loans and bonds, and then the funding choice between uninsured and insured deposits. That exposes them to endogenous runs, and they can then default. We take this model to the data, calibrate it to US bank call report data, and then that rationalize the cross-sectional of banks' portfolio and funding choices, and reveals 2 different causes of defaults, solvency and run defaults, that expresses itself differentially in the cross-section. And then we study cross-sectional effects of micro-prudential policies and find that the size-dependent capital requirement in this framework is the most effective at reducing run risk without causing too many side effects. Now, we're standing on the shoulder of giants. Many in this room have contributed to many of the papers that we are building on. So what we are doing here is synthesizing and quantifying many of the forces that the prior literature has put forward. We're putting that together so that we can rationalize banks' funding risk, portfolio risk, and run exposure choices jointly in the cross-section. So that's the key goal. So 2 graphs of data. So to motivate, this is what we are basically trying to capture in the model. The first graph is the security share in the cross-section of banks that is decreasing in the size of banks. So on the x-axis is banks sorted by size from small to large. And on the y-axis, we take the basically liquid asset share of banks, so cash, Fed funds sold plus securities over asset. And it's declining with firm bank size, but it has a slight upward tick towards the end. So very large banks, they hold more securities. Now, quite the opposite is then of that is the uninsured deposit share. It's increasing in bank size. So larger banks have a larger share of their deposit base that comes from uninsured deposits. So we are this is the goal of the paper, is trying to rationalize these causes, these empirical facts in a 2-period model. Now, in this 2-period model, there's a representative agent, a household, that gets some endowment, and they have preferences over consumption in the first period and liquidity in the first period, as well as consumption in the second period. There's a continuum of banks that provides the consumption good and the liquidity, and they are effectively, again, owned by the household. The government insures the insured deposits, not the uninsured, and that's paid by lump sum taxes that the household has to come up from. Now, this is a two equation that are complicated. As I said, the household likes liquidity. How are we gonna do that? I want to be a bit more transparent. So they like this liquidity term H, which is basically a CES, or is an aggregator of both insured and uninsured deposits that are produced by different banks that are indexed by I. And there's a lot of terms here, but what I want to take you away is that the key parameter here that I want to focus on is this differential degree of product differentiation between the insured and uninsured markets, so this rho I. So if there is more product differentiation in a given market, and all banks have the same degree of product differentiation, but it differs by deposit type, if there's more, banks can charge a lower interest rate relative to kind of a market rate. So the household just allocates their endowment to bank equity, insured deposits, uninsured deposits, earns the profits, pays the taxes in a zero period zero. Now to the banks, two important choices, portfolio and funding choice. The portfolio choice, in the first period, the banks can buy bonds at a price of 1 that have a risky payoff, RB, that is stochastic, so this is where interest rate risk comes in, and capital at the price of 1 that has also a risky payoff, in the first period, but is subject to decreasing returns to scale. And the reason why we have that is because we want to capture in the model a size distribution, and so we need this technicality of this decreasing returns to scale to do that. Now there's the stochastic, the risk, what is coming here from is like there's 3 productivity components, starting with this variable Z, which is actually not a risk, it's kind of a productivity type. A high Z is drawn ex ante from a distribution, but a high Z means I'm a very productive bank, a low Z means I'm not a very productive bank, and the banks know this ex ante before they take decision. RK is an aggregate shock, and epsilon, the role is an idiosyncratic shock whose role I will explain in a few slides. Now funding choices, they issue insured and uninsured deposits at some discount bond prices, similar to that. And the importance is that the uninsured deposits, and banks know that they're subject to this run risk, and banks take that into account. After runs, there's a default option with bankruptcy costs. So what our model can capture is basically different degrees of balance sheet differentiation across the size distribution, such that, for instance, small banks have a higher bond share, like in the data, versus large banks have again a higher bond share compared to the medium-sized banks, and are more funded with uninsured deposits relative to insured deposits. I want to solve the model backwards, and I hope I can do this in 2 minutes. There's just 2 periods, and the last period has 2 stages. The first stage, if there's a run, and then the second stage is the equity payout and default decision. So if there's a run, and these running depositors at the right-hand side of this equation take out their funds want to take out their deposits from the bank has to look at its assets. We have loans, we have securities. Which of these I'm going to liquidate to pay out the banks? So we assume that the loans are illiquid. If a liquidity problem, or like with a fire sale discount, if this is large enough, the bank would prefer the bonds to redeem the depositors, and that gives also a precautionary role of holding bonds on the balance sheet of banks. Now, depending on whether a run has occurred or not occurred, the equity payouts is different in the second period, because what I'm getting in the last period, what can I pay to the dividend to the shareholder, is basically whatever my loan produced in revenue, whatever my securities produced in revenue, and then I repay my depositors from that, whether or not they have stayed around, so if there's no run, or some of them have run, and then just I have to pay out the remaining depositors. Now, I want to now clarify what is this role of these epsilon. These little epsilon, they define the default threshold that we then can tractably capture default in this model. This is going to be still dependent on the choices of banks, but depending on this default threshold, we can kind of characterize when runs occur and when default occurs. So if this epsilon shock, this productivity shock is low enough, the bank is going to get insolvent. This is on this line here depicted. And we assume the bank is going to be shipped immediately to the FDIC or the receivership and no run occurs. If the epsilon is large enough, then the bank would survive a run, so no run occurs, also no default occurs. This is called the run-prone region. And then run, so therefore, can only happen in the run-prone region in this intermediate stages of this idiosyncratic shock, that then the run is only occurring with a sunspot realization with some random drawn probability. However, the size of that region is an endogenous decision by the bank. They can choose not to have any uninsured deposits, and then this region collapses and has no mass. Now, what's the bank's problem in the first period? So going back, they know all that. They choose, they expect them maximize dividends by choosing loans, bonds, all their deposit funding structures, conditional on survival, subject to the budget and regulatory constraint. Budget constraint, they have to purchase these loans and the bonds, and those have to be funded with equity and deposits. Banks internalize really the effect of their choices on the demand for deposits. There's this monopoly pricing in there, but also the pricing of their default risk for the uninsured deposits. Now, there's lots of, and I know that my discussion is going to go more under the hood of the model. There's a ton of parameters, but I want to focus on the key parameters here when I talk about the calibration. The parameters that I alluded to, this degree of product differentiation in the insured and in the uninsured deposit market. And we calibrate them to the Gini coefficients of uninsured. That gives us the high concentration of uninsured deposits in the largest banks, and the transaction deposit rate. And that results in that there's more product differentiation in the insured market compared to the uninsured market. And that's important for the results in the model. So let me get to this. So the first graph I want to show you, this is the last data slide that you're going to see mixed with model results, is that on the top here we have the model, on the bottom is, on the top we have the data, on the bottom is the model. The left column depicts the assets, the middle column the bond share, the right column the uninsured share. And you can see that the model captures the characteristics of the size of the cross-sectional distribution in these quantities pretty well. Why does it do that? So this is what we're feeding into the model, the loan productivity distribution, the CI. That if you're a more productive bank in our model, you choose a larger asset size. That's not surprising. But you also choose a higher uninsured share. Why is that? In particular, the small banks, they choose no uninsured share or a very low one. And the reason is really this, the product differentiation. For the small banks, their size, the optimal size is mainly driven by the deposit business, whereas for the large banks, it's a combination between deposit and the lending business. The small banks are basically just good at deposits, and you can make more money in the insured deposit market. That's why they exhaust their balance sheets size already with insured deposit. They can more than enough fund that. Whereas the large banks, they have a larger balance sheet size because of a profitable lending business. They don't want to go all in insured deposits because that would exhaust the margins they could charge on that. And therefore, they also fund themselves with uninsured deposits. The flip side of that is when the small banks have no profitable lending business to go in, how do they back their profitable deposit, the insured deposit business? Well, they fund that with bonds. And this is what we see. The small banks hold bonds to back the insured deposit business, whereas the larger banks, they don't hold bonds up to the very large because they hold, again, a sizable amount of uninsured deposit, and they face, that's the right graph, higher run probability, and they hold then these the bonds as a precautionary reason to hedge against run risk. Now, what happens if there's an interest rate shock in the model? So the model captures normal changes in interest rates. So when what is interest rate risk? For instance, a rate increase that lowers the realization of the return on the bond portfolio of the banks. That leads to solvency defaults in the small banks. We can see that in the left panel, in particular when the loan return was also bad. It leads only to run defaults, elevated run risk for the largest banks. And so we have these two causes of default, and then together they lead, then the right panel is just the combination of either solvency risk or run default. Now, what happens if there's an unanticipated rate hike event? So it's an extra low in the model, that's an extra low bond return realization. That unexpected rate hike nearly doubles the risk of runs for these largest banks in this model. Now, given these characteristics, what can we do? So in the last 5 minutes, I want to walk you through some policy counterfactual. Relative to the model that I've showed you, we've also now introduced for the largest banks a too big to fail guarantee. So that you know, because we thought that this was important, given that this is we think that this is a plausible environmental feature. Now, what happens if you tightened basically a capital requirement of the bank? That is the theta. Tightening means that we move it from 88% of assets against which you can borrow, you reduce basically the theta. That means tightening. That's highly effective at curbing the run risk of the 0.1% of banks. So it nearly eradicates all run risk. However, there's a standard trade-off that people familiar with this type of models would realize. While deadweight losses or excessive bankruptcy costs are curtailed in this type of models, we also reduce liquidity in this model substantially, which the households doesn't like. So now what's more is a targeted policy, which regulators already are pursuing, is introducing a size-dependent capital requirement. You can see the size-dependent capital requirement relative to what I've showed you prior on the bottom left graph. So this is how we tighten. The green line is where it's goes. This is tightening the capital requirement for the largest banks. Now, this leaves the uninsured share stable, and it's very effective at curbing the run risk of the largest banks because they are forced now to basically delever, and you can see that in the bottom, middle bottom panel. This is more targeted than the capital requirement across the board. Now, the second different policy that we've tested here is a liquidity requirement. So now we vary the amount of bonds you have to hold if you issue uninsured deposits. So this tighter liquidity requirement is also effective at reducing the run risk of the largest banks. You can see that here also in this green line. But when you see this, the green line compared to the blue line, the baseline, or a capital requirement, which is the red line here, it leads to massive changes in the bond share across the size distribution. So there is somewhat unintended consequences while we are trying to target the uninsured share of the largest banks and forcing them to hold more bonds. We are also forcing more bonds onto the mid-sized banks, which started to have some uninsured deposits that are actually quite good at lending, but they have to hold then bonds in order to fulfill this liquidity requirement, which this is the comparison of the model, leads to more dispersion in the productivity of loan allocation, let's say, of the productivity of capital. So it leads to misallocation of loans. This is what this red, the SD standard deviation of the marginal productivity of capital in the right column here indicated as red shows. It reduces run risk, but it comes at the cost. Whereas the capital requirement I already alluded to is really effective in reducing the run risk for the largest banks, but also has some lending, less lending and fewer deposits. Now, in the middle is the size-dependent capital requirement, which is way more targeted, and in this model leads to a substantial reduction in the run default probability without changing the allocation, the optimal portfolio allocation across the size distribution. Now, let me conclude in the last minute. So we, in this paper, we show model ingredients that are needed to match the cross-sectional heterogeneity in bank assets and liability positions. And what's really important and want to re-emphasize is the heterogeneous asset productivity, which is in deposit productivity and deposit product differentiation features that the IO literature has already emphasized. Really important to capture that. Then we find different manifestations of interest rate risk in the cross-section. For small banks, it's really solvency risk. For large banks, it has run risk consequences. And we do that then to study the financial stability consequences of micro-prudential regulation in the cross-section of banks and find that the size-dependent capital requirement reduces runs at the fewest side effects. Okay, thank you. Looking forward to my discussants.
And the first discussant is Augustin Landier from HEC. It's all yours.
Thanks to the organizers. Okay, so I will do two things. So first, try to give you the main intuitions of the model, and then some comments on the policy message of the paper. So just to place a bit the paper, so it's part of the post-Silicon Valley Bank regulatory debate. We know there is this potentially toxic mix of uninsured deposits and interest rate sensitive assets. And so there is a debate on, should regulation think twice about this issue? And so the paper's angle is to have a structural approach and build a model that jointly endogenizes the distribution of bank size, the funding mix that banks choose, namely, the level of leverage and the allocation between insured and uninsured deposits, and the asset mix that they choose between, investing in loans versus securities. And then the paper tries to use this framework as a policy lab to see, what kind of policies might improve welfare. Okay, so the goal of, the challenge in a sense that the paper is raising is to try to match three stylized facts at once, namely the distribution of bank size, which is very skewed, the security share that banks invest in. So these are graphs that Juliane already shown. I'm not going to discuss them too much, but basically there is this decreasing and somewhat U-shaped at the end distribution of the security share in banks' assets by size. And then the third stylized fact, it's the third graph, which is the fact that large banks rely on uninsured deposits much more than small banks. Okay, so the idea is to try to match these three facts. Okay, so let me give a very brief sketch of the model. It's a big challenge to give justice to the model in so little time, but let me focus on a few pieces. It's a big machine. I will focus on a few pieces. So the first one is, okay, what do banks do? So first, banks are different in their level of productivity. Okay, and this productivity matters for their ability to raise deposits, but also their ability to lend. And that's the same. Basically, there is a one-to-one correlation between the two things, being productive on the lending side and being productive in raising assets. Okay. So then, once they have chosen their liabilities, namely how much deposits they choose to raise and how much insured versus uninsured deposits they raise, they decide, how to invest them between loans and bonds. They know their productivity, so they know whether they are good at lending, basically. So then shocks arise. Okay, these shocks can be aggregate and idiosyncratic. And there are two types of issues that can happen. So the first one is a sunspot run on uninsured deposits. It can happen if there is some vulnerability to the bank, namely that, it could be that it's not able to fully pay its deposits if you don't run with others. So if runs happen, what the bank does is it has to sell its liquid securities, and it follows a pecking order, right? So first selling securities and then loans. But if it sells its loans, it does so at a fire sale price, so there is a pure waste cost to do that. Okay, and so if they are insolvent, at that point, banks default, They can also directly default if the shock they face is so big that actually a run does not even have time to happen. Okay, so the second big player is households. Let me spend just 1 minute on that. But the originality of the model is to try to basically have a representative household which has some preferences for insured versus uninsured deposits at each bank. And there is this big liquidity utility aggregator, which is going to be asked to match the data, basically. Okay, but so in this representative household, it's going to put a little bit of deposits everywhere, and it's going to be putting more deposits in banks that are productive at raising deposits. Okay, meaning that these deposits must be of high quality, in a sense the service they provide must be of high quality. But it's important to understand that here we have a representative household which is investing basically in all banks in the economy, a little bit of its wealth, and more so in banks that are highly productive. And households also have this sort of preference for having a mix of uninsured versus insured deposits, and this mix, which will be determined by alpha, is going to be matched to the data. Okay. So now there is a third player, which is the regulator, in a sense, which is going to try to basically maximize welfare in this economy. And it has two main tools in the baseline, namely a leverage constraint. So that's the parameter theta in the first equation. And a liquidity coverage ratio, namely, it can say, look, if you use, like deposits, you need to keep some liquid bonds in front of them. And so ask yourself, what are the sources of inefficiency in this economy? So there is a classic insurance externality, namely banks try to take advantage of the insurance on deposits. But it's not, let's dig a bit further, because there is a lump sum tax, so it's not distortive per se. What is distortive is that when default or fire sales are strong, they force banks to liquidate at a fire sale cost, which is assumed to be pure waste. So that's really what basically is the source of inefficiency. It's these fire sales that are basically forcing banks to liquidate their assets. The second source of inefficiencies is the fact that deposits might be misallocated. So there is a first best allocation of deposits that responds to these preferences of households. And if you regulate in a manner that, let's say, for example, is too favorable to large banks, you might destroy the ability of the households to dispatch their deposits efficiently towards smaller banks. Okay. And then there is an equilibrium. So let me accelerate a bit. So I will have, let me skip the policies. Let me directly go to my main comments. Well, I think the first one is, I don't think you want the paper to be that dependent on this idea that this curve is U-shaped, because it really relies on a few data points. I pulled out data from Europe, where also you don't have any symptom of a terminal U-shape pattern at the end. So in a sense, the model it's independent on that, but I think you don't want to emphasize it too much, this U-shape idea. So then three main comments. So the first one is, it's about welfare. So it's interesting, the structural approach and the way you match it to the data using these household preferences. Basically, the way it interprets this distribution of deposits that you see here, it comes from the paper. So you have assets on the horizontal axis and the rates on deposits on the vertical axis. And so small banks pay very small rates. And that's going to be mechanically interpreted by the model as the fact that small banks are very productive at producing deposits. So meaning that they must be providing really high quality services. And so here my point is really, do we really believe this? Or, an alternative explanation is that, they could just be exploiting unsophisticated customers, elderly people, or just, local monopolies that remain there. But the welfare interpretation is a bit dangerous, right? To rely too much on this idea that it's very important to preserve the deposit franchise of the small banks. It's an open question in a sense, but the paper takes a strong stance on that by interpreting these small rates as an indication that there is a high service provided there, high quality service provided there. The second one, it's a bit of a cheap shot, but the paper, obviously, it's already a big machine, so it leaves aside a big chunk of the economy, namely production, the fact that companies need to borrow, and so in a sense, all the inefficiencies leave aside, right, a big part of what we traditionally think as, the main inefficiencies that are involved with bank vulnerability and crisis episodes. So it's something, I think, to at least discuss in the paper, how much we should think when you tackle welfare analysis and optimal policy tools. That's something to definitely tackle. A small thing also is the loan fire sales, which are the biggest source of inefficiencies, apart from the misallocation. They are supposed to be pure waste, but someone is buying those loans. So ultimately, I mean, in the calibration, how much is wasted? It's a bit open. Let me finish with one point, and it's not about this paper. It's a bit more broad. So I think, in a sense, it's striking when we look at the banking data. How much small banks are going to play a big role in any kind of calibration exercise. And so it's a bit like the entrepreneurship literature, where we try to keep to as much as possible the idea that mom and pop shops are the same object economically as unicorns, but there are limits to that. And so sometimes I feel, maybe it would benefit from zooming on, the part of the distribution that is really important. And as you mentioned, it's extremely skewed, right? So this is the cumulative distribution of assets. And you see it's extremely skewed. So in a sense, it looks like, like getting rid of the top 60% of all your graphs, in a sense, will not, will enable the paper to zoom on what is really like driving the economy. But, it's an exciting paper. It's quite original, delivers compelling economic insights. It's a big machine, so to make it work, you need to leave aside some aspects, but definitely made me think about many issues, and it's courageous in a sense to really try to be structural on this topic. So thanks a lot, and I leave the floor to Markus.
The next discussant is Markus Brunnermeier from Princeton.
Thanks a lot. It's a pleasure to be here, and thanks for the organizers and everybody here, and for discussing this nice paper. So I would like to start with putting this paper a little bit step back, what the paper does relative to what the many other papers do, including Juliane's earlier papers. I would say, this paper has, of course, productive firms and households and the banking sector. But most of these papers focus on one banking sector and a time series focus. And while this paper really looks at the cross-section, so it looks across various banks. So the time series focus was very much in mind amplification, fire sales, and deflation, and spirals, and on all these things. And of course, fire sales occur in this paper as well. But it's all about, you might, through regulation, lower the amplification, but it might also delay the bounce back. There's a resilience trade-off and other things going on. And Juliane and others have done a lot of work there. In this paper, it's all about, or it's primarily about the cross-section. How does it play out across various banks? And I think that's a big contribution of this paper, and there's very little in that space compared to the time series space. So, and it's a big paper. There's a lot of things going on. So what I will do is I will walk through the paper and then say, okay, what about this thing? If we change it this way, I come with a lot of questions, essentially. What will happen if you change that? And I won't have all the answers, or very few answers. It's up to Juliane to provide them later on, or today. So essentially, the paper, the model is a two-period model. It says the focus is on heterogeneous banks. The banks, they have some loans with a return of RK and some other components. They can hold some bonds with interest rate risk. And there's also a risk-free asset. There's no portfolio choice between the bonds and the risk-free asset. That's actually, this omega is tied down, I think. So that's my first question. Why do you tie it down? Why don't you rely on a portfolio choice across all three of these assets? And then the banking sector can issue some insured deposits, some uninsured deposits, and then there's the bank equity. So that's going on the bank side. And then there's, of course, a repressive household, and that's already what Augustin indicated. There's liquidity in a utility function. So this psi parameter is actually pointing, so how important is this component? Otherwise, it's a simple Epstein-Sin utility function with a IES of 1 and a risk aversion of phi. And then in the liquidity itself has a CES aggregator in it with different weights on the insured deposits and uninsured deposits. And some banks are better than others, and that's the capital A is reflecting that. And it's a CES with some elasticity of substitution of eta divided by rho I. That's also, again, insured versus uninsured. So there are two components always playing in this. So this can be seen, I think, as a CES aggregator, but I think if you were to microfound it, because we don't have, a continuum of banks, each of us, you probably want to have a discrete choice model, but this would translate in the same CES liquidity aggregator. So that's, in the big picture, one big component of what's going on. So in terms of the challenge for the paper is that to set up this whole model, and I won't go through the whole model and then bring it to the data and calibrate the model. There's a lot of parameters, and there will be more parameters I will just mention. So the main results in terms of calibration is that there's a huge concentration in the size, in the banking size, and that's driven by this decreasing returns to scale in this loan technology. Some banks are more productive than others in granting loans. The large banks hold loans and issue uninsured deposits. So the runs occur in the large banks. And then there's the largest banks, they hold more bonds than the large banks. So that's a special for the largest banks. And then there are small banks, they hold bonds and issue insured deposits, and they focus essentially on the deposit business. And then there's some comparative static. So what happens when we make these bonds, these long-term bonds, more risky, more volatile, or we increase just the downside risk. Okay, so Juliane, I didn't have time to go into that. But the question is, once I allow some portfolio choice between the risk-free, short-term reserves, let's say, and a long-term bond, how does this change? That's one question. I can't answer it because it's too complicated to do on the spot. So the model in general has a lot of degrees of freedom. And in terms of calibration, there's also a question a little bit. It's a two-period model. And when you calibrate it, for banks, the franchise value is a very important component, whether you default strategically or not, or what situation you go into. How does the calibration depend? Is different from a two-period model, from an infinite horizon model, let's say, and then you have a much potentially bigger franchise value. And also depends, of course, on the discount rate as well. So if you change policy, the franchise value is changing as well. So how would this affect the calibration is another question, which would be interesting to answer. Now, what the paper is not, and that was initially I thought, the leading example would be Silicon Valley Bank, First Republic, or Signature Bank, but it's actually not about that. It's about that in terms of that the interest rate risk on the long-term bond is really the driving force, is a big driving force. But it's not because in the model it's primarily the big banks, and these were the regional banks driving that. But I think what would be nice in the model, of course, there's a lot of things going on, but what we saw is that people run from these banks into the big to fail banks like JP Morgan. Okay, so there's analysis on runs is very nice. It's always running out. I guess you run into cash, but what you really do in the real world, you run into some big to fail banks. And perhaps the analysis, there's a too big to fail chapter in this, but it doesn't have this run to some big to fail bank. And it would be nice to extend it to this way. So that's essentially one extension one could do. So let me go a little bit deeper with some little notation here. So how's the risk model? So there's aggregate risk, there's idiosyncratic risk, fundamentally idiosyncratic and aggregate risk, and then there's run risk as well. So the aggregate risk is this RK, so K is the capital or the loans you grant, that's the aggregate component to it, and then the bank has this epsilon idiosyncratic risk epsilon I. And then there's also some run risk, which depends on the sunspot realization, which is this var sigma, and then it also, of course, depends on the fundamentals of the fundamentals RK and RB. The RB is the return on the long-term bond. And the assumption here is that if you look at the total loan risk, it takes on Does this work? Yes, it takes the whole elements here. So it is some, I think it's now in the new version, it's called Z or Z, epsilon, and so on. If you're a better bank, you're more productive, and that's translated ideally translated in the model as a larger A. Okay, so you have higher returns. But if you look at the specification, it's also the case, if you have a larger A, you also have a larger risk. Okay, so you would say, okay, is it the case that more productive banks have also worse risk management? Okay, so that's, you might, because one argumentation would be that if you're a very good bank, you might also be very good in risk management. You might not be better in identifying better projects with high expected return, but you might be better to handling the risk. So if you were to change this specification, would the conclusions change radically or not? Which I don't know, but it would be interesting to figure out. The other assumption is that the return on the loan book, this RK, is independent of the return on the government bond or the long-term safe asset with interest rate risk. But if you think about it, if there's an aggregate shock on the loan book, typically as flight to safety, and then there's a negative correlation there. Perhaps one could include some negative correlations on flight to safety component on this as well. Now, the next thing I would like to say is that, of course, what the authors would like to do is they would like to have a nice size distribution across the banking sector. And what you do is you do decreasing returns to scale. But, in the banking literature, it's not always clear that you want decreasing returns to scale. You might want to have also some increasing returns to scale. Economies of scale, essentially, in the banking literature. But there's a lot of fixed cost, IT costs and all this. And diversification improvements happen as you grow the business. So I guess the justification is you first some increasing returns to scale. At some point, it will become decreasing. And I don't know whether that's easy to generalize and just include that. And then there's, of course, an economies of scope. Here, it's assumed that if you're very good in loan provision, you're also good in providing deposits, issuing deposits. There's some kink function. I don't have the time to go into that. One could change that. The other thing is, which I think is a big issue I would like to address, is like the fire sale discount. So there's an exogenous fire sale discount just by a fraction of delta. But if you think about it, you have a fire sale, you have a liquidity run. If you're in this range, this epsilon range, depending what positions you took, the solvency run, and that affects then the cross-section of the banks, and the cross-section of the banks affects, again, the fire sale discount. And so endogenizing this or making an equilibrium story out of it rather than exogenous would be nice. You can even have some deflationary pressure coming from the liability side as have deflation when there's a demand shock in the economy. Let me conclude, given that I underestimated the time. I think it's a first-rate finance paper. It's a very nice paper. It has a lot of things going on. It's a two-period model, but there's still a lot of things in it. It's not necessarily about the Silicon Valley Bank and First Republic Bank and Signature Bank. There's some modeling choices which I went through. It would be nice to extend it in various ways. And it has some very nice policy implications for micro-prudential, cross-sectional implications for regulation. Thanks.
So thank you. We'll follow the same procedure. And please remember to introduce yourself. I'll start with David. I'll go after you next, please. And then wait for, I think it's coming around. Please, yes, the microphone.
David Sharfstein from Harvard. So the paper and a lot of the literature kind of assumes that what banks are trying to do is maximize the present value of their equity. But if you look at the way banks are managed and how they think about interest rate exposure, they're very focused on volatility of income. And you can see this because when they report in their annual reports what their exposure is, a little bit less on the economic value of equity, and the things go in the opposite direction. An increase in interest rates generally helps you on the income side because your loans reprice faster than your liabilities, and hurts you from the economic value of equity perspective. And those two things are at odds with each other. But my sense is that the income exposure is much more prominent in the way banks are managing interest rate risk. And in particular, if you look at their interest rate swaps and what they're doing on the risk management perspective, they're swapping into receiving fixed rate, not receiving floating. And in some sense, you can also view the holdings of these treasuries and mortgage-backed securities as itself not an exposure to interest rate risk on the income side, right? In other words, it's hedging out the fluctuations in income. And I just wonder whether, I mean, it's hard to go to that, I guess what I'm suggesting is instead of having a 2-period model, you want to have a 1-period model and think about what the policy implications are in a world in which banks are thinking about it from a kind of ROE income perspective rather than the longer-term economic value of equity perspective.
For David for this great. You know, I'm very sympathetic to the idea that they are trying to maximize ROE, and I know very well that they think about interest rate risk in terms of income, not at all about value. As I have actually work that shows that banks use derivatives to increase interest rate exposure rather than decrease it on the balance sheet. So I'm aware of that. It is actually, you're right, actually, this would call for a different paradigm on writing down models and would deviate from standard ways to write it down almost radically, which we should do. I agree with that. We should do this because it's actually closer to where banks are. So let me also, I don't know if I'm going to get the opportunity to thank my discussants. I thank you so much for struggling through the equations and making sense of them in a thoughtful way. And I want to give other people also a chance to, I will use my opportunity later on also to respond to some of the comments.
Please.
Christian Kubica, ECB Research. Thanks for the great paper. I have a question on the omega that Markus has highlighted and the role of bonds in your model, because it seems to me that banks choose to invest in bonds for liquidity reasons, but that has the side effect of exposing them to interest rate risk. And so I'm wondering whether if you disentangle both, banks would still choose to be exposed to interest rate risk on their asset side on top of the loans that they originate. So I think that is more or less the same question as what happens if you endogenize the omega. And then relatedly, the presumably U-shaped distribution of bond holdings, I'm wondering whether it is simply an artifact of large banks being also dealers in the bond market and therefore holding a lot of bonds, the very, very, very large banks.
Okay, so let me answer your first question first, which is also related to Markus' comment. So we are actually working on a new version of the model that I didn't have. It takes time to calibrate it, so I'm not exactly sure about all the results, but we have extended the portfolio choice to reserves and bonds and the loans. So reserves are in the model the risk-free asset that banks can hold, and the idea was, well, would this undo? And the results that I'm looking at in my head, it goes through. So, but it would still be the case. So the reason why is because there is kind of this reach for yields. The reserves pay lower interest rates than what the bonds do. So they prefer to deal with a liquidity risk in some sense with the largest banks I'm talking about with bonds. So the smaller banks, they hold bonds for very different reasons than the large banks. So different motivation. They don't have good investment opportunities in the lending or other market. So that's why they invest in securities to, which then is coming back to David's point, that kind of hedges also the income. But it's in our model a side effect, which is consistent with the data, not as a result from keeping wall flat as opposed. So, but you don't have that in the model that banks would hold, large banks would hold bonds purely because they are market maker. All that is kind of packaged in what we call loans. Thank you.
Please just fill up and then we'll come back.
Thank you. Philipp Schnabel from NYU Stern. It's sort of following up on what David said. So my understanding, from talking to banks when they think about interest rate hedging is, you kind of look, what do you have on the asset side, what's the repricing, you try to match that what you have on the deposit side. And so, if you do that successfully, which it looks like it do in, at least in aggregate, is you end up with a stable NIM and a stable ROA. And so that means also when you have sort of like positive duration on the asset side, you look at the deposit side, you have negative duration there as well. And so, I know it's a big machine and you both emphasize the importance of the deposit franchise as well, but at least in our work, it looks like, the fact that the deposit franchise has negative duration is like really a first order consideration when thinking about interest rate risk management. And that is a reason why they hold some of these long-term assets. And it seems that's missing in the current version of the model.
So, thank you for the question. It's a great question. I would actually think that for the small banks, we would get that because we are focusing on the portfolio choice problem. So we don't look directly at the cash flows, but it would be the case that the negative duration of the deposits coming from the insured deposit franchise, let's say that the small banks have, would be perfectly matched by, well, I don't know if perfectly, but they do go into security. So I think that's kind of consistent with your work. We do not have a deposit franchise in the model. I think, to be honest, so actually we tried and we found that it just unclear how to calibrate its content and unclear how it would behave in a two-period model. So I think we want to go for that in a dynamic model, which was actually our original goal, but we got stuck in the two-period model. And then I think we cannot give it justice to do that. So we kind of left this off the table for other people to work on this topic. Yeah, that's a good question.
Emil Werner, MIT. So very nice paper, really enjoyed it. If you look at the banks that were subject to runs, for example, in March 2023, one thing that's interesting from the perspective, for example, of liquidity regulation is that actually the way that they managed the runs was not so much by selling securities, but by borrowing, first from the FHLBs, then at the discount window and the bank, the Fed's facility. So I wonder how, in your model, if you added sort of some facility that was an expensive source of funding that banks could access, where they would, if there was a run, they would lose some of the deposit franchise that they have. They might still have some on the uninsured deposits by replacing it with more expensive funding, but you're going to get a much smaller run region, and then you're going to have less of a reason to be holding securities, to protect yourself against runs. I wonder how you think about that.
That's yes. So to have another policy instrument in some sense, yes. So we could definitely do that. That is interesting. Let me also say, because Markus alluded to that, and Augustin also, that kind of we got motivated, and I got motivated by this paper because I've been long working on interest rate risk exposure and banking, but to put it in the model that was kind of always on my list, but I didn't do it. Then SVB happened, and then of course this seemed first order. So we were in some degree motivated by SVB, but our model doesn't speak well to SVB, and we thought about many things and how we can add more and more parameters to make this odd SVB animal happen, and we were not really satisfied with that. So another way also how as other banks have in the data dealt with these runs is using reciprocal deposits. So Shohini Kunda, for example, has a paper that shows that some of the banks that were very similar to First Republic and Silicon Valley Bank, they cracked on this reciprocal deposit machine, which means they had access to insured deposit by swapping some of the uninsured against insured deposit, and that stabilized some of these banks in an effective way. They looked otherwise fairly similar to SVB in the sense that they were mid to large size banks and that had a lot of uninsured deposits. But yeah, point taken, we can happily take this.
From Senfi. In your calibrated model, are capital requirements binding? Or put it another way, if you eliminate capital requirements, would you have positive levels of capital? And how would they be distributed in the cross-section of banks?
Excellent question. So that depends on if you are a bank that is fully funded with insured deposits, they are binding. If you are a bank that is funded with both insured and uninsured deposits, they may or may not be binding. And effectively, some of the comparative statics that we have in the model shows that for the largest bank, they can become non-binding. And that's kind of, again, also a way of hedging against run risk that they can do. Yeah, but for the small banks, they would be effectively binding in our model because they exploit the deposit insurance put from the Fed.
I think that's it. We will give Juliana and Discussants a hand.